There are different forms of capital and each of them is unique in its own way, but all of them are interconnected. Although they are all important, the degree of importance changes at different period of time. For example, if in the industrial era financial capital was crucial, in the post-industrial era human capital is essential.
Profit is quite important because it has helped us get to where we are, but now given the current state of the world, I think it is very important that it has a greater purpose. So the financial capital, social capital, intellectual capital, all these need to align to protect environmental capital and ensure that we have a sustainable future.
I think we should shift from shareholder primacy to purpose primacy, and that essentially requires change in mindset, change in understanding, because now people think about financial benefits, but they're not enough. They don't realize that they're too superficial, they're too short-sighted, and there are more things to life than just the figure at the bottom of the income statement that you get every year.
We need a shift from shareholder primacy to purpose primacy. Unfortunately, it might take a crisis to get there.
Ladies and gentlemen, thank you very much for joining us. It's a real pleasure to be here. As Jason was just saying, I am the Europe editor at CNN, and I must say I've spent the last few weeks on the campaign trail with some of the European parties campaigning to gain seats in the European parliamentary elections in Brussels. And this subject of capital and purpose and whether or not the human capital in the workforce is being used to the right extent and giving the right recognition comes up time and time again. I can tell you that many populist parties, this is just from my first experience of being on the campaign trail with some of them, following their activities, are quite successfully, it seems, leveraging the arguments of inequality and anti-globalization. Many of the people in the audiences of some of these rallies are saying that they're fearful for their jobs because of automation of the workforce. And at the same time, of course, we've got major climate change protests that brought the main retail district of London to a standstill for about 5 days, costing huge amounts of money just 2 weeks ago. All the while, as you can hear there from some of the young leaders of the future here at St. Gallen University, youngsters who are ambitious are saying they want more purpose when they go and join a company. It's not just about profit, it's about being part of something bigger, an idea, a community. So obviously this is what we're here to talk about today, the subject of capital for purpose, so that people don't question the actual purpose of the capitalist system itself. Now, before I introduce our panel of 3 guests, let me just bring up a survey that I've been asked to highlight to you. And I believe we can bring up this graphic here, which is essentially a survey of some of the leaders of tomorrow from St. Gallen University and what they believe companies' current priorities are on the right here and what they believe companies' current responsibilities should instead be. And as you can see here, many of the respondents believe that they thought that many of the companies are putting too much attention, attaching too much attention to generating profits. They believe that one of their focus points is driving efficiency, finding faster ways of doing things, producing and selling goods and services. But really what they should be attaching more of their attention to is, on the left-hand side of the chart, improving society, developing new products and services, innovating, generating new ideas, 46% of the respondents thought, as well as, of course, generating jobs and providing employment. Now, I don't know about you, but that 36% of generating jobs and providing employment at the bottom of the chart really stuck out to me, and I presume that also speaks to the desire to have a more flexible relationship with people's jobs, and we'll get into that during this panel. So without further ado, let me introduce our guests. Sitting immediately to my left here is Mumenthaler, who is the Group Chief Executive Officer of Swiss Re, one of the world's biggest reinsurance companies. We also have Audrey Choi here, who's the Chief Marketing Officer and Chief Sustainability Officer at Morgan Stanley, and Professor Colin, the Peters Moores Professor of Management Studies at the Saïd Business School at the University of Oxford. So 2 representatives from the corporate sector enacting change, and also somebody from the world of academia who's familiar with the regulations or guidelines that need to be put into place to change the system. So I wanted to start out by asking my panelists one obvious question, and let's start out with you, Mumenthaler. If not profit, what should the purpose be?
You know, I think every company has a purpose, it wouldn't exist otherwise. So it's doing something. It's using inputs, it's producing output, it's doing something. It's just remarkable how few have explicitly formulated what their purpose is. And that purpose, if you compare companies to organisms, is never to make profit. That cannot be, I think, a genuine purpose. The purpose might be to produce shoes for people to walk, or medicine, or in Swiss Re's case, what we have formulated is to make the world more resilient, because that's what we do. We take premiums all over the world, and then we pay to people who need it in Chile in 2010 or Japan 2011, so you can reconstruct economies. You make the system more resilient. That's the fundamental purpose, and I think not enough has been made out of it to formulate it, because I think most purposes are actually positive. Not maybe all, you wouldn't like all of them, but most of them would be very positive. I think also that leadership teams all across the world, they look at what they have to do in different ways, right? There's huge differences. If you go to China, leadership teams, CEOs, etc., would see their role very differently. They would see themselves as part of an overall system and having to deliver to the overall system. And clearly, they would say profit is not the most important thing. The most important thing is to, be part of the system, serve the harmonious society, which is the goal of the whole society. If you take, Switzerland, or I think Europe in general, it's not profit. It's a multi-stakeholder approach. Sometimes it's actually in the law, like in Switzerland, right, where the boards of directors have to take care of the company, not of the shareholder. It's a much broader concept. And then the US has the more extreme, shareholder-driven approach.
But irrespective of all of this, the same arguments are being discussed around the world. The outcome, irrespective of people's different systems and relationships with capital and profit in the C-suite, the outcome, Audrey, around the world tends to be the same arguments and the same disaffectation. So how do you think things should change in terms of the purpose versus the capital?
Well, I think one of the things, one of the biggest changes that we've seen is really that, as you said, there's this enormous desire for purpose. And our belief as a large financial institution is that we have to figure out how we can really, instead of setting up this dichotomy about sort of profits versus purpose, it's how can you harness the profit engine and all of this incredibly efficient global system that we've had that is towards maximizing profit. How do we harness that sort of in the service of purpose? And so, at Morgan Stanley, we really think about how can we harness the capital markets so that we can really drive not millions or billions, but actually trillions towards these massive challenges that we have. Because if you look at the biggest challenges we're facing, whether it's poverty or climate change, the two things that we know for certain is that those trends are, especially climate change, is increasing exponentially faster, and that all the philanthropy and the government money in the world is not enough to fix that. And so it's really about, what we're seeing increasingly from the industry, but also really investors, whether that's, a 20-something-year-old starting their first job and starting to invest, or the largest pension funds in the world, is thinking, how do I need to align my profit calculations better with these purposes? Because ultimately, and this is where I think it really comes together, is knowing what we know now. We know that things like climate change or poverty and political unrest or gender inequality actually can affect the bottom line. And if you are trying to run a company with sort of a blinkered sense of things and saying, if it's not on the financial statement, it doesn't affect my business, is a completely antiquated notion. And we have to figure out how to bring those factors in and understand that it can increase your risks and therefore your loss potential, or it can increase your profits if you do it the right way.
Colin, just going back to this concept of the corporation, the company, and its purpose, it's changed radically, hasn't it, over the last generation or two?
Yeah, it certainly has. And I think there is now a realization that the purpose of business is not to produce profits, that the purpose of business is to produce profitable solutions to the problems of people and planet. And in the process, it produces profits, but profits are not per se the purpose of businesses. And that's what successful businesses recognize, and they don't profit from producing problems for people or planet. Now critical to that is the extent to which companies are trustworthy in doing that. It's all very well having that as a statement, but are they actually doing it? And underpinning that are the values of businesses, namely values of honesty and integrity, and cultures of committing to those corporate purposes. And I'd just like to illustrate this, if I may, in relation to one example that I think is very pertinent in this regard. It's a pharmaceutical company that's very prominent in the field of insulin. It's Novo Nordisk. It's a company that has been very successful at positioning itself in that market, but it recognized that there was a problem in terms of reaching the large proportion of the world that suffers from diabetes. 80% of diabetes occurs in low or middle income countries. And they recognized that people just couldn't afford the product. So they then pursued a policy in terms of essentially cross-subsidizing from the developed market the price at which they were selling it in developing countries, which was quite an interesting development. But then they realized that actually that wasn't their purpose at all. It wasn't simply to sell insulin, even in the developing world. It was to cure people who got diabetes, but also to prevent people getting diabetes, type 2 diabetes, in the first place. And they recognized that that had a lot to do with lifestyles. It wasn't simply a matter of just diagnosing a pharmaceutical solution. It was changing people's lifestyle. And so they built up partnerships with universities, University College in London in particular, but universities around the world, with governments, with local authorities, with medical professionals, doctors, hospitals, to establish how could they change people's lifestyles and what if someone did get diabetes was the best way of addressing it, which might not involve them taking insulin. And you might say, well, that's all very worthy, but doesn't it basically kill off the golden egg that the goose is laying and undermine the very business model of Novo Nordisk? And the answer was absolutely not. It did exactly the opposite. It has been a great source of business growth and expansion for Novo Nordisk. Why? Because, of course, in the process of doing this, they became recognized as someone who was, as an organization that was really interested in solving the underlying problem. And so they became a trusted supplier. And as a consequence, they built up relations with governments, with medical professionals, with hospitals, etc., by which they become a preferred supplier for a whole range of activities. And I think it's indicative of the central importance of trust in business. Trust is one of the most important assets that business has. It's a largely unrecognized asset. It's barely discussed at all in a business school course. But to my mind, it's probably the most important asset of a company.
I'd have to say, as a journalist, I'd agree with you, but I might be biased. Our industry has put trust over capital for many, many years. Audrey, Novo Nordisk is a listed company. Would shareholders have the patience to digest the arguments that Colin was just making before? You know, the idea of this could be killing off the goose that lays the golden egg, if you like. And also, the time horizon of shareholders becomes more and more demanding these days. The short-termism goes also contrary to this ability to try and find a purpose, doesn't it?
So I think that structurally we definitely have a challenge with the short-termism, especially, frankly, in the U.S. system, where the pressure of every 13 weeks, having your quarterly reports and whether or not you make that, that earnings estimate on the button or not, is a huge issue. There was actually a survey that was done, a study that was done that something like 70 to 90% of a company's value is actually based on projects that aren't going to happen for another 3 to 5 years, right? So that whether it's that research pipeline for a company or the future innovations you're working on, and yet when CFOs, the chief financial officers, were polled and said, would you invest in this NPV positive project that's a 3 to 5 year project if it would cost you missing your earnings estimate by a penny? 55% of CFOs said no. Right? Because if you think about the time horizon of quarterly earnings, the time horizon of a CFO's tenure, the time horizon of a management person, and then the time horizon of when this value is going to come to be created. So, I think the kinds of work that, that Dominic Barton and the long-term, capital is really looking at in terms of that, how we have to think about what are the consequences. Having said that, I actually think that this short-term, long-term dichotomy is one of the things that often provides sort of an easy out. And people say, oh, well, you're right, all those things are right, but, either my board or my shareholders or my mandate is that I'm supposed to have maybe a 1, maybe a 1.5 year time horizon. So sorry, Audrey, I can't think about that sustainability long-term stuff yet. I think that's kind of an easy out, because I think what happens, and we're seeing it more and more every day these days, is that a long-term consequence could happen tomorrow, right? Because it's a long-term consequence of something that's been building for the past several years, and we're starting to see that it can really actually, ignoring or being proactive about it can really affect short-term earnings.
So when's that dynamic going to change? It's interesting to speak to you because you've been in the CSR space for some time now. Mm-hmm. You were previously in government, the Clinton administration. Does this message have to come from government? Does it come from industry? What's going to be the catalyst for change?
I think that actually one of the, I think there's several catalysts. I think it's, look, government and enlightened policy around the world certainly has an enormous effect. Having said that, investors and the trillions of dollars that are sloshing around the capital markets have an enormous effect if they actually start having intention. And what we've seen in the last 2 years especially is a hockey stick of acceleration around the world of investors saying that they believe that things like climate change, social equity, are actually material to earnings and are material to how they want to manage or de-risk their portfolios. So for example, in the US market right now, it's about a $12 to $13 trillion market. So 1 out of every $4 under professional management has the investors saying that they want some sort of environmental or social mandate attached to those dollars. Globally, it's $30 trillion. And Europe is actually the largest section of that, but America's been growing very quickly, and Japan, just in the last 2 years, has tripled. So we are seeing this real move there, and again, I think the reason that why we're seeing the move is, and this is the other driver of change, is as whether governments and investors realize that things like environment can have a major effect on earnings. I'll just give you maybe just 2 quick examples. One at the macro level and one at the micro level. At the macro level, we've just seen actually a report out from 30 central banks and multilateral institutions around greening the financial system, where they have said that climate is a meaningful material risk and a threat to financial stability, and that banks and corporations have to understand how climate change can affect their business. When you take that down to the micro level, and why, as I was saying before, it's not an issue that profits is short-term and sustainability is long-term, what our research analysts have done is they've actually said, okay, let's look industry by industry at all the various environmental, social, and governance factors and see which one of them really matter. And so, you as a CEO can't keep track of 574 different, metrics, but there's probably a couple dozen for you as a financial that matter, a couple dozen for you as an automotive, and then let's really see what are those factors, whether it's water usage or environment or labor practices, that are not currently on today's balance sheet, but should be. And when we did that, we've seen our analysts change their calls for the 12-month earning period, or even for the 13-week earning period, change their calls up or down from an overweight to an underweight. And it's things like a company that, I'll give you, just if I can, a quick example on the upside and the downside. There was one company in a particular sort of heavy industrial sector that everyone knew was not the best actor in its industry in terms of water usage, community engagement, but it never really showed up on the balance sheet. And so it kind of kept on puttering along. But when our analysts actually went through and said, wait, these things have material consequences, how do we think about water usage and community engagement even though they're not on the formal balance sheet? What they saw was that because this company was not doing a great job of sharing water access with the community, that they were on the verge of being slapped with an order to do a feasibility study for a desalination plant, which meant potential unanticipated CapEx of potentially up to $1 billion. And at the same time, because the community engagement was not great, they were slower and slower and slower to get permitting for new sites. So you don't need to care about the environment, you don't need to care about water, and you don't need to care about people. If you're a chief financial officer with unanticipated CapEx and lower revenue, that suddenly is a financial issue.
Well, at this point, it becomes a risk issue, doesn't it?
Absolutely.
Which is where we come to the insurance sector. I mean, when obviously there's so many more purposes that I'm sure the audience wants us to tackle rather than just climate change, but you're at the forefront of climate change. You could suffer massive deviations to your balance sheet depending on natural disasters that could be caused by climate change. What about the purpose? Is that one of the big
no,
purposes?
absolutely, right. I think since every company has a purpose and ours is to make the world more resilient, I think it's good to attach to a particular theme that matches you. I think there was a young gentleman this morning, an entrepreneur, saying having a CSR department on the side is useless, and I agree with that, right? It has to be part of the business. So we cannot deal with all issues, but climate change is one. In '94, we were one of the first companies publishing that this is a real risk, and we have tried in the beginning to persuade politicians and people like that. That was successful, right? But since 10 years plus, it's more about, okay, it's going to happen anyway, so how do we adapt, how do we mitigate some of these risks, and what can we do about it? And I think the worrying bit is I don't think the world has a plan, not even a remote plan on how to deal with it, right? There's high-level talk, and we should do this and this and that, but it doesn't add up yet to something that will work. And so that's something we're engaged with, right? That's where we're still very active.
So the difficulty for you is that companies like yourselves are trying to do their bit, partly because it's good business and you protect yourself from the risk that we were talking about before.
I give you two examples, right? I think the fact that this theme is now up gives us a certain mandate to act. So, for example, 2-3 years ago, we were able to shift all of our assets, 120 billion, into ESG benchmarks. I think 20 years ago that would have been hard, right? We'd have had, headwinds from investors. Now it was really accepted. Last year we increased the policy where we're not going to support, producers and coal power plants, right, anymore in the developed countries, which means loss of business. And that, I think, again, 20 years ago maybe wouldn't have been accepted. Now there's much stronger pressure here, which gives us a mandate also from a shareholder perspective to do more.
Are you feeling pressure from shareholders asking you to espouse some of these values, or which way is the dynamic going?
I think
or is it
for
you
us,
deciding
it's very much the contrary, right? I think it's very much the contrary that I think we're leading and explore how far we can go.
Do you get pushback from them then?
No, we were good with that balance, right? Because I feel very passionate. We all feel very passionate about that. We see it happening, and it's just you should never lose sight of how this works, right? In the end, owners, hire us, and we have to serve for the company. So we have to be conscious of that. So it's always the question: how far can we go with these measures and bring our owners along? And I think we have been successful with that. But so far, for us, it's not pushing. We are, I think, pushing the boundary.
I just want to pause for a second for our panelists so that I can ask our audience to, over the next few minutes, vote on a particular question via your applications on your mobile phones. And this is the one here. As you can see, what purpose does profit serve? Obviously, in your views, we've taken the views of some of our panelists. Profit is the best universal metric for success. Without profit, there is no innovation and no entrepreneurial risk-taking. Do you believe that the purpose of profit defines itself by what it's used for? Or is our focus on profit to measure economic success, and does that need a fundamental overhaul? Colin, do you think the whole system needs a fundamental overhaul? Do you think it needs to come from regulation? Do you think it's country-specific? Does it come from inside companies themselves? I mean, obviously, the UK and the US offer a rather different model of capitalism than places like Switzerland, but the UK, the country where you and I come from, the big headline on the 4th of January every year is that the average CEO has made in 3 days the same salary as their average worker. Headlines like that, for many decades, don't help industry, let's face it.
Well, let me answer that in relation to what we've just heard. And we've heard a lot about how companies, investors are perceiving that one can do what is termed doing well by doing good. and that investors are concerned about material risks associated with doing bad. Companies are increasingly understanding the importance of doing good and the way in which it's potentially a profitable activity. But the notion of doing good by doing well is actually quite a dangerous concept. It first of all implies that one doesn't do well by doing bad. But we know that there are a lot of companies, what are sometimes termed the sin stocks of alcohol, gambling, fossil fuels, whatever, that do extremely well, thank you. But it also implies that if one doesn't do well, that one shouldn't be doing good. And that's, I think, the fundamental issue that arises here. It's all very well if by looking after the environment, looking after society, it's a more profitable activity. But the central question is, what happens if it's not? And what happens if environmental catastrophe is associated with having to earn lower profits? Is the financial system going to respond? Well, Audrey made the point that of the $100 trillion under management, a very small fraction of that is actually real impact investing, investors willing to take less than a market return. And if that's the case, then the extent to which doing good being associated with not doing well is going to be consistent with investors' preferences is going to be very limited. And that, I think, means that one does have to think about something that's somewhat different from just saying, well, are investors moving in the right direction? Are boards of directors recognizing the importance of this? Towards thinking about, well, what really is the purpose? If ultimately it's constrained by not earning any less in the way of profits than we are today, our abilities to solve the problems of the future are going to be very limited. And that's why, to my mind, it's important to think in terms of this notion of purpose as being about solving problems. Okay? It's not just that it's not about making profits, it's also not just about making goods and services. That's what Novo Nordisk has recognized, that it's really there to solve a problem. And that then allows you to address the types of questions that you've just been asking about the divergence of income between those at the top and the bottom. It means that one has to think in terms of, well, do we have the right governance arrangement for ensuring that we do have appropriate differentials between people at the top and bottom of organizations? And if the governance arrangement is, as at present, essentially dominated by the shareholder primacy view, the answer is we will probably not solve that issue. But if we think in terms of solving problems, including those of motivating employees and making them feel they're getting a real purposeful form of employment, then indeed I think one might address those.
Now, I'm glad you went into the subject of motivating employees, because obviously I realise there's so much that we haven't yet talked about in terms of intellectual, human capital, and so on and so forth. But many of those employees feel that perhaps companies they work for could do an awful lot more to continue education, continue lifelong learning, to prepare them for the next wave of industry, the automation of the workforce. Is that something that you think companies haven't yet embraced to the extent that they probably should? And obviously we're in a great famous institution of learning here. You're a professor at another famous institution. How can that be rejigged through the corporate sector?
Well, that's exactly what comes out of this, that if you think in terms of the purpose of the business, one of the purposes of the business is to ensure that its main asset, its human assets, are ones that are going to help deliver those purposes. And as automation changes the nature of employment going forward, there are two responses that companies can have. They can simply lay people off, or they can think about ways in which they can retrain, reskill people to be able to provide the different types of services going forward. And let me illustrate this in relation to one sector where there is some of the most dramatic change about to happen, and that is in banking, where the introduction of artificial intelligence, the introduction of the social network companies moving into the fields of banking, are going to mean that, in essence, the traditional role of having someone that one's connecting to in a bank is going to change very substantially. And banks have to recognize that automation is not going to be a solution to what we as customers are seeking. There's a real opportunity of supplementing that automation with a form of returning to relationship-style banking, to having people that you can really connect with, that have an interest in you as a customer. And so by thinking in those terms as to, well, what is the bank actually there to do, then the notion of how automation creates opportunities for reskilling employees and giving them a new sense of purpose is one that I think is very considerable going forward.
So let's move on quickly, because I realise time is of the essence, and get that answer from the survey that we just asked you about before, and then we'll get some views and some questions from the audience. Let's see whether we can just bring up the survey, and as you can see, there you go. Obviously, we can see that, well, there's a bit of an interesting split there, but 38% say that the focus on profit to measure economic success needs a fundamental overhaul. That's quite similar to what we've discussed here on this panel, but that without profit there is no innovation, no entrepreneurial risk-taking. So some rather realist views, I'd say. Let me start by getting a few questions from the audience, and then I'm going to come to you, Christian, with your views on what that showed. Anybody got a question? Could you raise your hand? Gentleman over there. Thank you.
Thanks very much. Colin, I have a question for you. You mentioned Novo Nordisk, and you also mentioned Unilever yesterday, and Paul Polman, who really tried to do similar things as Novo Nordisk, you know, really change, and then he basically had to reverse some of these policies because he got this takeover bid. Now, what is the right ownership structure that actually can help companies to think in that long term? Because, Ms. Dos Santos, you said Novo Nordisk is a listed company, but it's not quite true, and maybe, Colin, you can talk about that. The majority of the voting rights of Novo Nordisk is in a non-profit foundation. So the power and the money supply is decoupled, and maybe, Colin, you can elaborate on that.
Yeah, so Novo Nordisk is a company that has a very interesting ownership structure. It's a structure by which it is listed on the stock market, it's actively traded on the stock market, but it has a dominant owner, which is an industrial foundation. Now, it's a foundation, not in the sense that the company has set up a foundation to give away its profits. It does have a foundation like that, but it's also a foundation that owns the business. And as such, it provides a degree of stability to the company that if it just had a dispersed ownership structure, it might not possess. And that allows it to focus on the long term. Now we had a discussion a little earlier on about short versus long term, which said that there's a lot of evidence to suggest that markets do price in longer-term investments. And you just have to think about Amazon, the fact that Amazon was trading at unbelievable multiples when it was earning negative earnings, cash flows being negative. But what that doesn't reflect is, and the case of Unilever illustrates that very well, that dispersed companies are exposed to changes in views on the part of their institutional investment community. Now, Paul is often upheld as being sort of archetypal, purposeful, led CEO of a business. And as you mentioned, that attempted acquisition by Kraft, which only lasted a weekend before it went away, nevertheless had a very substantial effect on the business. And I think it's illustrative of the fact that if one is to have purposeful companies, one needs to have inspiring and inspired leaders of those companies, but one also has to have supportive shareholders. And I think that this view that institutional investors are appreciating the importance of material risks is a significant development, and it's a desirable development. But frankly, it's not enough, because we've got this strong emphasis now on the environment because there's a realization of the catastrophe that's about to happen. But there are similar catastrophes that are going to happen in terms of our political and social systems if we don't understand that this is more than just isolated problems popping up here and there. It's a fundamental problem about the nature of the purpose of business and their abilities to be able to deliver on those purposes.
Let me just take another couple of questions from the audience, and I'll ask you, lady at the back, please. I'll take two at a time, if that's all right, thanks. And can I ask you to keep them brief, if possible? Thank you.
You spoke about businesses needing to trust companies to do good, Professor Mayer. And indeed, I think a public criticism of ESG is often that it's just a marketing exercise, which isn't helped by it often being the responsibility of the CMO. Where do you think ESG commitments should best fit to ensure the right balance of short and long-term goals in a company?
Okay, thanks. And then let's take, does anybody else have another question? Let's take these two here, thank you. Lady in the middle, and then Rajiv.
Thank you, Nina. This question is to anyone in the panel who wishes to answer it. India began the experiment, I think, 4 years ago, of taking 2% of the profits before tax of all companies, and that had to be deployed in CSR activities. And it's done two things. It's brought focus on many of the SMEs as well, and many of the larger companies who were focusing only on profits and not on the society they live in, it's brought them to look at that, and in fact has forced them to spend money, and that has to be reported in the accounts also, in the annual report. Would you favor such a system on a more global basis? That's my question.
Okay, thank you. And we'll just take the lady's question over there.
Thank you. This is for Professor Mayer, and I wanted to ask, what is the role of benefit corporations, if any, in the transformation of the purpose of businesses?
Okay, thank you. Well, right, so Professor Mayer, let's start out with the first and second of those questions.
Okay,
yeah.
well, actually, I'll start with the third, with the second, and then come back to the first and third. On very complicated.
Your prerogative.
Very complicated. Okay, so the CSR initiative in India is an extremely interesting one, and India very much led the way in terms of putting forward this notion that there should be a common objective of companies in terms of allocating a certain proportion, 2% of their profits, to CSR activities. Now, that was a very brave move to make, and it's had a lot of desirable consequences. There are a lot of debates about, well, to what purposes are companies actually putting those CSR expenditures. But it's also, I think, rather bringing us back to old notions of CSR as being solutions to the world's problems. CSR was a much favored notion a few years ago in terms of you make a lot of money and then you give it away to worthy projects. And that's what the robber barons did, the Carnegies, the Mellons, etc. They made huge amounts of money and then they sought redemption by giving it away to worthy activities. That's not what we're talking about here. We're talking about instilling a notion of the purpose of companies as being core to its activities, and that the element of solving problems as being part of their business structure. And that comes to the first question about ESG and the extent to which ESG is improving the focus of companies. Again, the answer to that question as to what should be the balance on ESG is in terms of, well, what are the problems that companies are trying to solve? So if I take the example of Novo Nordisk, it's got a very strong focus on solving a social problem. You know, that's problem number one. It hasn't got, it does have various measures in terms of its sustainability in an environmental sense, and it does a lot in that area as well. But you know, its real focus is on that. And therefore, the balance between environmental, social, and indeed profitable activity, you know, one shouldn't suggest that this is in any way undermining the importance of profitable activities. The balance between those activities should vary across companies depending on what problems they're trying to solve. And to come finally to the public benefit corporation, just to explain, public benefit corporations are a form of incorporation that were introduced into the United States over the last few years and has spread across some 35 states in the United States, by which companies are required to state a public benefit, a public purpose, alongside their normal commercial profitable functions. And there's a fiduciary duty of directors to uphold those public purposes. Now that is very much along the lines of what I'm discussing here. The advantage is that it requires directors to do that. The drawback is, so far it's predominantly been associated with relatively small companies in the United States. And the large listed companies have not, for the most part, adopted this structure. Danone in France is potentially going to be one of the first companies to become at least a benefit corporation, which isn't quite the same, but is along those lines. But what one really needs is the notion that the C Corps, not the B Corps, are ones that are adopting this notion of a purpose as being core to that activity, not just that it's something that's restricted to some small companies adopting them in particular circumstances.
Well, our time is almost up, so I just want to make sure that Audrey and Kristen, you get a chance to weigh in on this as well. In terms of the three questions that were asked there, we had, broadly speaking, one about whether or not the change needs to come from the top, as we were saying, from a governmental level, and also what type of ESGs need to be invested in. What would you have to say on the particular side?
I would say it sounded a bit negative on Paul Polman, right? I think he's a real shining example. I know him and I've always followed him, and I think he was a huge success, right? He has been CEO for a long time, he has changed things. And I'm a real believer it has to be your core business and it has to be CEO-led.
And it's not just even in his own company he's changed.
No, also for a lot of people like myself, inspired by that, because he really looked at where do we take things from, what do we produce, how many people do we have, what are the world's problems and where do we contribute to these problems, how can we solve that, how can we optimize that, and he talked about all of that to his employees, to his shareholders, to everybody, and had a huge effect. And I think every business can basically do that, right? And therefore, I'm also not in the CSR camp. We have a few people doing that on the side. I think all companies need to think, where are we in society, where do we contribute, and how can we change things?
Audrey?
Yeah, I would say two quick things. One is similar. I believe that we will actually achieve the most social change if we have businesses thinking about these solutions as a fundamental part of their profit engine, right? So if you can be the company that thinks about the best solutions to water purification, to providing affordable quality healthcare, to providing affordable, environmentally friendly housing when we're going to need to build more housing globally in the next 20 or 60, the next 60 years than we have in the past 2000, that's a huge area for profit. I think that in terms of levers of change, though, to maybe try to end on a hopeful note, I think there's an unbelievable amount that the people in this room can do even without government change. I think one is, for the students, companies absolutely are paying attention to what the best and the brightest next generation of talent wants. And the fact that this next generation cares about purpose as a fundamental part of corporate strategy and is thinking about that holistically across their work, their investments, and their sort of nonprofit activities is a huge signal to employers. The fact that we've seen a sea change from asset owners actually taking their portfolios and saying we need to de-risk it from climate risk, we need to be proactive about gender and poverty. That is causing a huge ripple effect in the capital markets. And then finally, I think this issue of whether it's new forms of incorporation or things like the Sustainability Accounting Standards Board, in full disclosure, I'm on the board of that organization, but it is really looking at saying, how do we make sustainability issues part of what people understand as the metrics that every single company should be reporting on and being measured, and that's a way that you can start to understand those risks and opportunities as core to the business.
Before we leave, I want to ask you two, because I know, Colin, you mentioned that trust is the above all purpose for you, and I'm with you on that. Christian and Audrey, the one purpose that's the most important here for each of your organizations, if you had to pick one?
Well, for me, clearly, it's different for every organization. And for Swiss Re, as I said, it's making the world more resilient. That's really, I think that's a measurable thing we do. That's not a fluffy thing. It's really by taking premiums all over the world, paying it to the people who need it, we fulfill an essential purpose for society.
And explaining that purpose is key. Audrey?
Look, I think for the financial services industry, trust is absolutely the most important thing that determines whether people, will do business with you. And I think for us, the purpose is how do we use that trust so we can really harness the power and speed and scale of capital markets towards positive social change.
And my purpose is to try and keep us to time for the moment. Thank you very much. Audrey, Choi from Morgan Stanley, Kristen Mumenthaler from Swiss Re, and Professor Colin Meyer from Oxford University Saïd Business School. Thank you very much for such an enlightening discussion, and thank you to the audience for joining us.